Hey, welcome to video number 4 in the series. This will be the first where we actually get into, real technical concepts, actual numbers and stuff. So we're going to talk about risk-reward ratio and win percentage. You may already know these concepts, but we're going to kind of go through them and tie them into everything we've talked about and kind of start building all the money management on top of it. So first, let's talk about risk-reward ratio. Sometimes people write RRR, or they just write R equals something. What that essentially means is how much you're willing to win versus how much you're willing to lose. So I'm going to use this example of an inverse head and shoulders, just as an example, because I think it's a buy signal. A lot of assets and crypto, you can't short them, you can only buy them. So it's a buy signal. It also has kind of a built-in target. They say you should, if the head of the inverse head and shoulders is 8%, your target should be, 8% above here. So you should set your stop losses, 8% above. And they say, again, this is what people say, and I'm not condoning trading inverse head and shoulders or that it's even real, but I think it serves as a good example. They say you should set your stop loss kind of below the shoulder here. So let's, in this example, just say that that's 2%. I know that's not to scale or anything, but, bear with me. So in this case, you would have a risk-reward ratio of, risking 2% to get 8%, which is 2 to 8, which translates to 1 to 4. Right? A lot of people will say 4 to 1 risk-reward ratio. I think it maybe rolls off the tongue better that way, but that's incorrect. That would be a reward to risk ratio. Either way, it doesn't really matter. It's all the same shit. So if you're trading an account size, well, let's just say a trade size of $200, that would mean that 2% would be $40. Well, what is that? Why am I so bad at math? Equals $4. Sorry. So your risk is $4, and your win would be $16. So you could save a risk reward of $4 to $16. So yeah, it's a pretty straightforward concept. The next one is win percentage. So your win percentage is how often your take profits are hitting versus how often your stop losses are hitting. And I'm saying it like that because it's not just how often you're right versus how often you're wrong. It's we talked about in the last video, what qualifies right and what qualifies wrong. If the price goes up to 7% up and then goes down, were you right or were you wrong? Technically, your system was wrong because your system predicted there. So you should, if you have different risk reward ratios for different systems, you should kind of log them all differently, because you would say, well, my 1 to 4 one, my 1 to 4 system has a 10%. That's not how you write 10. A 10% win rate. It's really bad. That never works. But when I go 1 to 6%, then I get 60% or something, whatever. So you can kind of have to qualify your win percentage by what your risk reward is. Because if not, you could say your win percentage is anything, because what exactly is a win and what exactly is a loss. So in this example here, to have in the 1 to 4 ratio, to have a break-even win percentage, you would need a 20% win rate. You can call it win rate. Some people call it strike rate. You might think it's 25% because it's 1 out of 4, so you think it's a quarter. But just to draw it out, if you do 5 trades, 20% of that would be 1 trade. I mean, you won 1 trade and you lost 4. And 1 times 4 is $4. And 1 times 16 is a win, $16. And 4 times $4 is also $16. So you broke even with 20%. In this case, you're breaking even. So what would you have to do to make money? So let's say you want to keep your risk reward at 1 to 4, you'd have to increase your win percentage. So let's say you increase it to 30%. So let's do the math there. Let's say you do 10 trades just to increase the numbers a little bit. If you have a 30% win rate in 10 trades, that means you're going to win 3 trades and you're going to lose 7 trades, right? So you win 3, so 3 times 16 equals, you made $48, and you lost 4, so 7 times 4 equals $28. and that minus that equals $20. So you profited $20. So you went from breaking even to making money just by increasing your win rate. And obviously, if you had a bigger risk-reward ratio, that number would increase, and if it was lower, the number would decrease. So one thing you might notice immediately is, well, 30% is less than 50%, and that means you're actually losing most trades, and that might sound counterintuitive. You might think, well, if you want to be a good trader, you have to win more than you lose, right? Well, this clearly shows that that's not true, and in fact, some pro traders will have like a 15% win rate. Because again, like we talked about in the last video, they let their winners run and they cut their losers short. So they lose a lot. They're losing all the time. But when they win big. They might win 1-8 ratio. The other concept that might kind of seem wrong, but is actually fine, is if you have the opposite risk-reward ratio. Like if you have a 4-to-1 risk-reward, you might think, well, that's really bad. You're risking way too much to win very little. And I'm not saying that's good or bad, but what I'm saying is if you actually do the math, okay, so how much would you need to break even on a 4-to-1? Well, it would be the opposite. So you would need an 80% win rate. So if you do the math, do 10 trades, 80%, that means you won 8 and you lost 2, right? And now because your risk reward is 4-to-1, that means when you win 2%, and you lose 8%, right? That's a 4-to-1 risk reward. So these things get flipped. When you win $4. When you lose 16. Well, you won 8 times. That's 32. And you lost 2 times. Times $16 each. Is also $32. So you broke even, right? And we could do the same thing we did over here. We could increase it by 10%. And let's do that. So now that means you win 9 times and you lose 1 time, which 9 times 4 is 36. And 1 times 16 is 16, right? So that means you end up with $20. Okay? Now, getting a 90% win ratio is obviously very difficult, but maybe you have some kind of system where you have this really lopsided risk reward. The point is, if you look at this number here, this $20, and you look at this number here, this $20, it's the same shit. This one you had a 30% win rate, this one you had a 90% win rate, but you ended up in the same place because of the opposite risk rewards. And that's sort of what I'm trying to illustrate here, is that there's no such thing as a good risk reward or a bad risk reward or a good win percentage or a bad win percentage. It's all about how you make it work within your system. And you can have a 1 to 100 risk reward if you want to do that, and then you just got to win 1 out of every 99 trades. I mean, that sounds crazy, but maybe you'll do it. To me, it's like when people say, you're eating almonds, and they're like, hey, almonds have a lot of protein. And it's like, well, do I have a protein deficiency? Am I trying to eat more almonds? Like, who cares? Like, things being good doesn't matter unless it works within your whole strategy. And I hear a lot of people say, I got 80% win rate, or, this high risk reward. Well, we just showed that, 80% win rate, you can actually lose money or break even, So let's kind of just put this all together. I'm going to make like a little pretend strategy. Let's say we have a, $1,000 account, because we're big ballers. And let's say we want to risk 2% of our account in every trade. So that would come out to $20, right? Yes. Just double checking so I don't watch this later and hate myself. And let's say you're going to do a risk reward ratio of 1-to-1. So in this example, it'd be like going up 2%, going down 2%, right? So what that means, when you win, your take profit is also equal to $20. When you win, you make $20. When you lose, you make $20. And let's say you do 100 trades, and you have a 55% win ratio. So let's do that math. You do 100 trades, you're 55%. That means you win 55, you lose 45. 55 times $20 equals $1,100. and you lose 45 times 20 bucks equals $900. And that means you made a grand total of $200, right? Pretty straightforward. So what you can do with this is you can create what's called an expectancy. I hope I can spell this correctly. Pretty sure that's how you spell it. And that just pretty much means like what you expect to make. So obviously the numbers aren't going to be exact. You're not always going to have exactly 55%. Your risk reward might not be exactly 1-to-1. But you can say, okay, I make 100 trades in a month, which means I'm going to make $200 per month, right? If you make 100 trades in a week, you're going to make $200 a week. You might be thinking, well, $200 a month is not very much, and that's true, but you can do two things. Number one, you can just add a zero here, and that would add a zero here. Now you make $2,000 a month. You can keep adding zeros. The other thing you can do is you can start to set goals for yourself. Like you can say, okay, well, what if I tweak this and I say instead of 1-to-2, I want to do instead of a 1-to-1, I want to do a 1-to-2 ratio, and instead of 55%, I want to do a 60% win ratio. Like I'm going to improve my trades, and I'm going to set my targets a little higher. Well, that would mean that all my wins go up from $20 to $40, right? So in this 100 trades here, I would win 60%, which means I'm winning 60 of those trades, and I'm losing 40 of those trades, right? So if I'm winning 60 at $40 per win, that becomes $2,400. And I'm losing 40 times 20 equals 800. And that comes out to $1,600. So look at what happened there. You went from making, before I added those zeros, you went from making $200 to $1,600. That's like 8 times more money. So obviously I could just sit here and add, a 3, a 4, or 5, and those numbers will go up, and we can, fantasize about that. But it does give you the ability to tweak your numbers. You can punch all this stuff into a spreadsheet and start saying, okay, what if I get a 1 to 1.5 risk reward or something like that, or a 62%? And you can kind of start seeing how these numbers affect your trading. And the thing that I really like about all this is that it kind of proves with math all the stuff we were saying about how if you boil things down to their simple elements, it gives you a lot of confidence. You kind of prove like, okay, I have a winning system here. I'm going to make $200 approximately. Obviously nothing's exact, but you kind of get that confidence, and you get that feeling of, I just got to make sure I keep these numbers in order, and I'm good. What it also does is it gives you a way to test anything. So like going back to the offense versus defense thing, this working on money management rather than your edge. Your edge can kind of be anything, because let's say you say, I'm just going to buy whenever some guy on Twitter says buy, right? Because I like him. You can buy every time he does it. You test your numbers. You say, okay, he had a 60% win rate, and I always went 1-to-1, and I ended up making this much money. And that's it. I mean, you could do that ridiculous full moon example we talked about in the last video. Like, I buy every time there's a full moon, and if I take a 2-to-1 or a 1-to-2 risk reward, I end up getting 60% correct. And that's why I think the money management is more important than the edge, because it gives you that undeniable proof that something works or doesn't work. Is this guy's calls correct or not correct? Are my calls correct or incorrect? And once you have that, it's sort of like the math will set you free, right? You don't have to worry about anything. The math is telling you you're going to make money. And I think that, leads to everything we talked about: better psychology, less stress, more confidence, more control, and leads to more consistent and profitable trading. So that's it for this video. We'll see you at the next one. If you got any questions, comments, or hit me on Twitter. Thanks for watching.